Let's say I own Meta and all this stuff came out about Meta and I was up big on the company, I'd sell my shares and I'd be out.
That's extraordinary. That's NVIDIA type numbers. And
Right.
obviously but then you have to question why are these accounting issues present and how big of a problem is that?
Those are the four companies that I own now that I've bought and I plan to hold for life, or at least until something changes.
Try to swing where the pitches are is how I look at it. Because if it's giving you an opportunity, try to swing at it, but also don't try to force it.
All right, folks, welcome to Investing for Beginners podcast. Today we have episode 376. We got two great listener questions and an interesting conversation towards the end. So let's go ahead and dive in. So first question is from John. So this is from Twitter. I'm still struggling with portfolio management. In my portfolio, most of my stocks are high growth and have good moats. I am trying to figure out which stocks in my portfolio have comparatively lower risk. I'm having trouble directly comparing the individual moats because they are also different. I'm handling the valuation risk by adjusting the size of each holding appropriately. So this is far more of an exercise. I'm not considering valuation. My thoughts are that my stage 5 companies have less market risk than the companies at other stages in the business cycle. And also that my low beta companies have relatively low market risk. Is this correct thinking? How would you group well-performing wide moat stocks in a given portfolio into risk buckets? So a lot to unpack there. Maybe let's start with the first part of the question. So how do you think about bucketing companies based on risk and maybe potential strength of moat versus maybe weakness of moat?
Yeah, I love it. It's a very tough question for sure. Mm-hmm. It's a tough question. I don't know if there's an easy answer to this. I like the idea of basing some of that on what stage a company is in. If we know just in general, younger stage companies have a wider range of outcomes, then that they're probably riskier versus something that's more mature, but not always. Historical growth plays a part in this. How capital efficient a business is plays a part in this. But I don't think there's a blanket answer. What about you?
No, there's not really a blanket answer. And it depends on, I think some of the things you have to think about when you're thinking about how do you position size companies, A, where they are in their life cycle, B, what kind of risk does that entail for that particular company? And then how do you want to handle that as far as the mental aspect of it? And so if I think about, I guess an industry that kind of would jump to mind would be the two companies I'm going to throw out are not exactly apples to apples in comparison, but they are broadly in the same tech field. So one would be Snowflake, which is a newer company, very early on in its life cycle, at least as a public company. I'll admit I don't know that much about it, so it may have been around for 22 years before it went and IPO'd, and I just don't know about it. Entirely possible, but unquestionably at an earlier stage of their life. And then you have a company like IBM, which is on kind of the opposite end of that cycle, if you will, and they're probably definitely in the mature phase, and you could argue, depending on how negative you want to be about the company, they're on the downward part of their life cycle. If you look at those two companies, how you want to position size those would be really kind of how much volatility can you handle and the uncertainty of both, because they both have some uncertainty. Is IBM going to be able to continue doing what they do and maintain their market share, or are they going to continue to lose some of their market share? Whereas Snowflake is earlier in their stage, and so they should be gobbling up lots of market share at this point. And if they're not, then that could be something that would cause some uncertainty and a lot of volatility in the company, or not in the company, in the investment or the stock. And so those are things you have to weigh, and how much can your stomach handle that kind of thing. And I don't think there's any hard and fast rule. Andrew, we could argue about this, right? But Andrew has a risk tolerance that is different than mine. And so, he and I may go, okay, let's invest in IBM. He may go, the risk is a little bit too rich for me, so I'm only going to go 1%. And I may say, I'm okay with the risk, and I may go 3 to 5%. It doesn't mean that we're right or wrong necessarily. Time will tell, but it really comes down to, like, as Peter Lynch said, the stomach's the most important organ in investing. Like, how much can you handle? And I guess that's kind of how I would try to approach it.
Yeah, I agree.
If you had to, between 1 to 5, like if you looked at, let's just take those two companies maybe for an example, like how would your risk tolerance be with a Snowflake versus an IBM, and kind of vice versa?
I would 100%. Here's the risk averse guy on the one end of the spectrum. 100% look at a company like Snowflake as being more risky, unless I felt like I knew that business really, really well. And there were things that I could recognize between this business and the average business in its life cycle that tell me that this is actually an exception to the rule. A good example of this that kind of popped in my head as you mentioned the word Snowflake. I'm reading a book right now that was recommended to me by Seoshin, who's in our community, and it's called something about Lessons of Darwin.
Yeah. What I learned about investing from Darwin.
Yeah,
Great book.
Great book. Yeah. So I'm not done with it, but there was a part in there where he talked about companies can get market share, but that like he has like it sounds like a personal slight against TAM, or total addressable market.
Yeah.
And he said, what the TAM doesn't tell you, sure, the TAM tells you how much market share you can take, but it doesn't tell you how profitable that market share will be. And it doesn't tell you if all the profits will accrue to the company in the industry you're in, or if it will be your supplier or your customer. Like we look at cloud, like who's taken the lion's share of that? It's been AWS and Azure and stuff. So an example of that would be, I don't know if you remember the electric scooters that have littered various towns.
Yeah.
I mean, Bird and Lime took all sorts of market share. Has that been profitable? It has not. So just based kind of like on that mental model, and then not knowing anything about Snowflake, just knowing the stereotypes, I'm stereotyping, of young growth companies, then that's why I look at that as pretty risky. And I would definitely want a circle of competence on the business and the future of the industry and all of those things before I change my mind on that.
Yeah, I would agree with that wholeheartedly. So how would you think then about, like, if you have a basket or a collection of like well-performing wide moat stocks, like how would you balance the risk of those? So let's just throw out some names just for fun. Like if you're looking at companies like Costco, Visa, MasterCard, Apple, Google, I don't know, Walmart, like how would you think about those as far as like allocating capital to those? Because they're all strong, wide moat-ish companies. And like, do you just blanket, okay, all 5%? Or, do you go, okay, I like this one better than this one and this one better than this one, kind of thing? Like, how would you try to think about that?
Give me all of the wide moat businesses. Right. And those. Give me as much of my portfolio in those.
Right.
In all seriousness, I think, this is just my personal opinion, so take it with a grain of salt. But I believe strongly in taking what the market's giving you and then also respecting diversification. So in the example of like Visa and MasterCard, if I felt like I had enough exposure to payments, then it makes no sense for me to add MasterCard if I already have what I call a full position in Visa. On the flip side, if any of those companies you talked about all of a sudden go on sale and you have the opportunity to add to it, by all means, don't play with the percentages, try to swing where the pitches are, is how I look at it. So all of that to say, like, I don't think that those situations will be very common because everybody knows who the white moat businesses are. So that's why I try to stress taking what the market's giving you, because if it's giving you an opportunity, try to swing at it, but also don't try to force it if you can help it. It's hard.
Right. It's very hard. We all want to own, the well-performing wide moat stocks. I mean, that's what we're all looking for. And I would probably argue most of us, if you look at your portfolio, probably would say they all are wide moat, well-performing stocks. But the statistics and the truth are that that's not the case. and we all have, 2 or 3, 5, whatever companies in our portfolio that are always laggards, or ones that were like, if I could replace this player with that player, then my team would be perfect, kind of thing. And sometimes that's true, sometimes it's not. And I think it's really hard, like, to your point, you have to swing when you have the opportunity. Everybody and their brother wants to own Amazon or Costco or Visa/MasterCard, but sometimes the valuation is not the right time to buy that. And so you have to kind of account for that. And so you can't just buy them just cause. I mean, you can, but buyer beware. Sometimes you pay a high price, you might have to wait a really long time for that outperformance to catch up to what you paid for it. And granted, they're great companies, but there's an opportunity cost to that. You could find something that could provide you a better return over a shorter period, and maybe not over a shorter period, that's not the right way of putting it, but it would earn you a better return in a quicker amount of time than waiting for another one to, one of the wide moat companies. Let's pick on Amazon. If you buy it at too high of a price, you might have to wait to get a 15% return. You might have to wait 5 or 6 years, depending on what the price you paid, where you could find something like maybe a less well-known stock that has a wide moat and get a 15 or 20% return in a shorter amount of time, which in the long run would be better for your portfolio. So,
yeah, 100%. So you kind of don't prescribe to this idea of like trying to assign position sizes based on the risk characterization of the stocks you're looking at?
I mean, to me, it's all a function of kind of the margin of safety kind of thing. Like, if we go back to the Snowflake and the IBM example, I may take a smaller swing at Snowflake than IBM, just because I feel like there's more risk and it's harder for me to value than it would be to value something like IBM. Mm-hmm. And so therefore I would probably take a smaller bite of that. And that's how I would account for the risk, is by using the valuation to help guide me about how risky do I think this is.
Yeah, I think there's a ton of wisdom in that. If Snowflake, again, to use just as an example, becomes the next Tesla or NVIDIA or something like that, whether you put a 1% size or 5% size, it's still going to have a huge impact on your portfolio. Mm-hmm. Where if in the off case it's not one of those crazy outlier stocks, having a smaller position size does protect you. Mm-hmm. Yes. I do like that approach. Yeah.
Yeah. Yeah. And I mean, there's something to be said for not trying to hit a home run with every single investment, and right. trying to be a little more consistent. And I mean, there's lots of roads that lead to Rome, right? But there's a lot of different ways you can structure your portfolio, and depending on your personality and your mental ability to handle volatility, some people, can swing for the fences and bet on a lot of different things, and that could work out great, but I'm not built that way. So that's just not the way I like to do it.
I like to do it for my daughters, because it's
right. Yeah. Yeah. I'm happy to do it with her money, but she's 12. So she's got, 55 years to make up for, a few foolish, investments that dad made for her. So
yeah, I still tease her about Petco.
Yeah, I'm sure.
But she also has NVIDIA, which I don't have. And
right.
She added to NVIDIA like I never did. So yeah. I have to keep my mouth shut.
Yeah. Yeah. The bragging rights, I can tease her about Roblox, but then she's destroying me with Spotify. So okay.
Right. Yeah. That's funny.
Yeah. Some wisdom in there, right? All right. So moving on, we got this great question from Martin. He sent us a question via our newsletter at einvestingforbeginners.com, which, by the way, is in the show notes. So if you have a question, you can send it to us. So this is he asked if we would consider doing a podcast episode about SMCI, which is super micro computer. He said, this is the first stock I bought, started at just over $18 a share and averaged $25 per share. So it brought me some small profit with potential large gains or losses if things go bad for them. This is not a long-term value investment in my eyes, but I believe it may be very profitable in the next couple of years. So not exactly what you guys are teaching on the podcast, but I think it may be an interesting test case. They're an AI company highly dependent on NVIDIA, with revenue coming from few large customers, burning cash, yes, accounting issues, yes, potentially a little moat, jury's out, potential of delisting, so many red flags, but also incredible potential to grow with example of project for Tesla, Meta, etc. So this is, again, from Martin. So great question. We've never talked about SMCI before, so this could be a fun conversation for Andrew and I, and hopefully everybody listening.
No promises on the last part.
Yeah, no promises.
First off, thanks for writing in, Martin. This is fantastic. I love that you dove in, you bought your first stock, and it sounds like it's done well for you in the sense that, what is this, almost a double?
Yeah.
If you were to sell today. So that would be a fantastic, I mean, yeah,
that'd be awesome.
It's hard to do much better than that. So
yeah, I can't complain.
Good job buying the dip on that. And we'll see where the stock goes from there.
Mm-hmm.
Definitely an interesting company to choose to talk about. I know it's been in the headlines a lot on CNBC and things like that. And there has been a lot of drama around some big pieces of what's going on under the hood, if you will.
Mm-hmm.
So what are your thoughts on this question from Martin, and what kind of jumps out to you?
Well, I think if you look at, just quickly looking at like the stock chart, for example, you can see that the company was just kind of plodding along, and then the whole AI thing started, and it went to the moon, and it has since fallen quite a bit since going to the moon. So it's kind of your classic, if you want, maybe you could term it a bubble stock. You know, maybe in its own little world, it was a bubble stock kind of thing, where it caught a wave to, not a surfer, but to use a surfing term, caught a wave, and then it crashed and burned. So, I mean, in that respect, it gives me pause, like, but if you look at what they're trying to do as a business, I think that could be really interesting, and really interesting for a little while. Like they could have a good runway to capitalize on kind of what's going on, not just in the AI space, but just in the cloud computing space as well, and networking and all the things that are going on in the world with computers. And so they could be positioned to do pretty good in that respect. So that makes it potentially interesting to me. I guess that's kind of my first, initial reaction. What were your initial reactions or thoughts after we started kind of looking at the company a little bit?
Didn't get a whole lot of information about what kind of a stock purchase was this. Like, is this something, bought a couple shares just to kind of have a little bit of fun and see how the market works, and have something to follow that's exciting? Not much on the exciting spectrum for buying a company like Watsco and waiting for them to sell a couple more HVAC systems than they did last year. Obviously, something like this on the cutting edge is very exciting. So if it's just, if we're just talking about a couple shares, it's total fun games, then that's awesome. Like, yeah, continue to enjoy and watch. And if you lose the money, you lose the money. If we're talking about investments, like long-term investments, which I don't think we are, but if we are, to me, there's enough red flags here where it's not, I mean, I would take those gains and I would run so fast if it was in a retirement account, or if it was significant money, because the red flags are piling up. And I look at a lot of stocks. I look at a lot of S&P 500 stocks. It is very rare for me to see what's going on with the accounting. That is not common. No. So for them to have an accountant, and then for them to replace their accountant, and then that accountant to resign, tells you something.
Not a good sign.
And it's not common.
No, it's not common at all. So can we like double click on that a little bit? Like, I know you were kind of reading some stuff before we came on the air about that. So maybe you could share some of your findings with our fellow listeners. Yeah.
If you're curious to follow along, I mean, obviously you can follow the trail of blogging and news articles and Google and all of that. But if you use a tool like bamsec.com, you can see all the different 8Ks, which are the official company press releases that are updating investors on the big developments in the company. And so, since May of 2024, they got a notice from NASDAQ's threatening to delist them because they had somebody who was on the audit committee that resigned and they didn't replace that person. There's also a ton on here about, the change in accountants. The accountant who said, "Hey, we're resigning from this." They basically don't want any part of this, it sounds like. And then the company filing for an extension to file their annual report because they did not file it, probably because of a lot of this accounting stuff.
Mm-hmm.
They did not file it when they were supposed to. So it's more than a year late at this point.
Mm-hmm.
So that's a long time. And so, that worries me. I mean, obviously you look at the financials and the numbers look spectacular.
Mm-hmm.
It's amazing what they've done to be able to take operating profits from less than 100 million to what is it now, like 1.2, 1.3 billion.
Yeah.
In less than 5 years. That's extraordinary. That's NVIDIA type numbers. And
right.
Obviously they're partners with NVIDIA in the sense that they buy from NVIDIA. So the growth is completely astounding, but then you have to question why are these accounting issues present and how big of a problem is that? I don't know, because I've never had a stock where it got delisted before, but like, what do you do with those shares? If you can't trade them on NASDAQ, like, is anybody going to buy it from you? Is it just
Dead
a
money.
number on your, dead money? Or money?
Yeah.
I don't know. I've never done the research on that. I've never had it happen to me,
Mm-hmm.
but those type of things would definitely make me concerned. And I would take the numbers that they've reported historically with a grain of salt, because if there's trouble under the hood, it could be something, it could be an oil leak, or your whole engine could be completely out. I don't know.
Yeah, that's what makes it hard, is that, to your point, when you look at the financials, they are spectacular, especially from, a revenue growth aspect and the profits. But then you have to question, are those numbers that you're looking at, are they real? Are the revenue numbers exaggerated? Are they recording revenues when they haven't shipped the product yet, kind of thing? And that happens, and it's rare, but it does happen. And that's obviously kind of fraudulent. So if you see those things and you don't know what to trust the numbers on, then how do you do any sort of analysis on the company? I mean, you're basically buying it because you like the logo colors. I mean, it's like, that's, to me, that would be the hard part. It's like, if you have two accounting firms quit within less than 6 months of each other, that's no bueno. And I know we can sometimes pick on accountants, and there's a favorite line of mine from The Big Short where this guy's like, accountants, work like 2 + 2 = fish. And when you're talking about investing in a company and you can't necessarily trust the numbers, then that makes me real suspicious about whether this is something, if I owned a company, let's say I own Meta, and all this stuff came out about Meta and I was up big on the company, I'd sell my shares and I'd be out. Done. Thank you. If it turns out to be a whole bunch of smoke, I can buy back in at another time. But until I know that that's on the up and up, that would be really scary. And I know you mentioned when you were doing a little research that one of the board members that was part of I think was the advisory committee or accounting committee, quit. Yeah. And so you combine that with the 2 accounting firms leaving, those are 3 huge red flags. Because if you can't trust management, then it's a hard place to invest in.
Yes, very hard. And there's historical precedent. And I'm not saying that this is going to repeat, because every time period's different, but in the .com bubble, when everybody was going crazy about wanting to get connected to the internet, you had a lot of double ordering going on, and revenues that were booked that ended up not turning into revenues because of the double ordering. And then when the whole craze popped, the bubble popped there, then investors got burned, and you saw stocks like Cisco go absolutely, crater.
Mhm.
So, we've obviously seen this stock crater, and I have no idea what's going on with the AI stuff. Nobody really does at this point. But it's just another thing to keep in mind, that when you talk about technology infrastructure, there are other, history has shown that there can be things that happen that you don't see at like Coca-Cola or something like that.
Right.
So you have to be careful.
Yeah, for sure. I mean, Martin mentions here that he doesn't feel like this is a long-term investment. And I would agree with him. I think that's a good assessment. But I would also say that based on what the company does and what you've seen from the air quote of financial performance, if that turns out to actually be legit, then this could be something that would probably warrant at least being on a watch list to pay attention to and see how it could, once the smoke clears and the dust settles on all this, then it could be a whole lot of nothing burger, or it could be something very serious. And I would hate for anybody to invest in something, because this could go to a zero if it is serious, accounting issues that they are fraudulently doing things. It could easily go to zero, and that's when you're going to lose all your money. And so, but there is potential here, and so that would be something that I would probably, if I was doing it, I'd be like, okay, I made some profits, thank God, I'm out. And then I would put it on a watch list and just see what happens. And if everything turns out to be a nothing burger, then you can buy back in, because it'll continue. I guarantee it'll continue to drop, as this plays out, because they have until February to get their 10K out. Is that what you read? So, it's not tomorrow, but in the world of finance and big business like these companies, you don't just crank one of those things out on a weekend. It takes a little time to put together a 10K. So, the clock's ticking. So
yeah, buyer beware.
Very much buyer beware. But it's a great question.
Yeah, I love it.
Yeah. All right. So let's move on to our last little tidbit. So this is a question that Sir Andrew asked in our community on Value Spotlight, and I thought it would be kind of fun for us to talk about on the air. So the question is, what is your biggest, air quote, buy and hold for life stock? So this is a great question that Andrew asked. And would you like me to take first serve, or do you want to go first?
Please.
Okay. All right. So I told him I had 4 companies that were on my list. Number 1 was Microsoft. Number 2 was Costco. Number 3 was Visa, and number 4 was Berkshire Hathaway. So those are the 4 companies that I own now that I plan to hold. I've bought and I plan to hold for life, or at least until something changes.
Right. Very nice caveat.
Yeah, very nice caveat.
How long did it take you to get to that mindset for each of those?
Oh boy. For Costco, it probably took me longer, in part because of valuation and in part because I didn't truly understand the business. When I first encountered Costco, I thought it was more like a Walmart or an Amazon, where it was like just basically a big warehouse. And I didn't realize that I didn't connect the membership in the warehouse and like how important those two are to each other, and how important the membership is and what it can really tell you about the strength of the business. Somebody who's worked in a subscription type business, 92, 95%, renewal rates is like, that's kind of redonkulous. So even as great as Netflix is at that, they would kill for those numbers. So, that's an awesome. So, I mean, once I started to put that together, then it became a little more obvious. Visa was pretty much, once I figured it out, that was kind of a no-brainer. Microsoft probably has taken me the longest of the 4, just because I still am working on the AI opportunity and the cloud opportunity, and how the Windows subscription kind of fits into all that, and Teams and some of the things that they're trying to do. They got a lot of moving parts, and there's a lot going on with that company. So, but it's also the one I've owned the longest. My first share back in 2014, and so I've held it all this years, and I don't see any reason. There's nothing that I've seen on the horizon other than maybe Satya leaving that I would make me want to leave at this point.
Yeah. That's awesome. And what about Berkshire?
I've been thinking about this one a lot, and I love the company and I love what they're doing. And I know that I've been thinking about like the Buffett question. Like that's kind of the biggest unknown with them right now is what's going to happen after. Charlie is gone. Warren at some point will not be there either. And I just, the more I think about like what Berkshire does and how they operate, he has really, I think he's done a really good job of kind of removing himself from being an important part of the overall business. He obviously still has a big impact on the investment portfolio, but he has been reducing that reliance on him over the years. And certainly for the operations of the business, I don't think he has much to do with anything. He probably really doesn't talk to Greg or Ajit unless it's ready, getting prepped for the annual meeting. I just think he lets them do their thing. And so to me, even though those guys are older, if Warren, God forbid, passes away tomorrow, I know that the stock will drop, but I still believe in what they're doing with the insurance. They're still best of breed in insurance, and I don't see that changing. And all the other businesses they own, from the railroads to the energy cycles and to the other standalone businesses, I still think are really strong. And I don't really see that changing much. So to me, that makes it, unless those things change, I see no reason to sell the company.
It's amazing to me just how the scale that they've grown, like from however many millions it was to, obviously it was over decades, but like when you start to hear some of the numbers, like, oh, if I put $1,000 into Berkshire when Buffett started,
right,
like those numbers can really start to get mind boggling.
Mm-hmm.
Like you're like, what? Like, how is this possible? It's got to be one of the most extraordinary things we've seen from any capital allocator ever.
Yes.
And you can't argue that because it's just been amazing.
I wish I had bought it 30 years ago, but hindsight is always 20/20, right?
I saw back in the day, like the whole emo scene. I don't know if you ever saw that.
Mm-hmm.
They're like, why didn't you buy a house back then? And it's like, I was doing this, and they're like on the mosh pit and stuff. I just thought it was a funny little thing.
That's funny. All right. You know what's coming? Your turn.
Oh, man. Yeah, I've got companies on there that obviously you just talked about. Costco for me would be a great one. They still have a long way to run, obviously. And then I think their subscription plan has a pricing power that can keep up with the economy for a very long time. And you could argue they don't even really pull that lever, and they certainly could. I think Alphabet for me is another one of those. And alongside, I couple that with Visa, because both of them are basically economic toll roads. The services they provide are essential to the economy, and as the economy grows, so do they, in a very natural way. And I think that's rare, and that's what puts them on the list. And then for me, it's also Pulte Group, which I've talked a lot about lately, so I'll say less. But they have just a super long runway, still a very fragmented industry. And they've been on a path that's very prudent. And until that changes, as long as the industry doesn't go bonkers, you can argue even if it does, then Pulte will be the one to emerge as long as they stay prudent. But as long as they maintain a prudence, then I could see holding that for life.
Yeah, I agree wholeheartedly. And I was thinking about this the other day. In the last few years, we've seen the erosion of companies' moats or just company business performance from giants of the past, and I'm referring to three different companies: Intel, GE, and IBM. And all three at one point were at the top of the mountain, and you can easily say that none of them are at that stage anymore. And Intel has been more recent, but GE went through a very big I guess deacceleration of what they're doing over the last few years, and IBM has kind of been a slow gradual burn. And to me, I don't know all those companies intimately. I know Intel better because I owned it, but the other two I don't. But it gives you an appreciation for companies that continue to not sit on their laurels. And I think of Visa and MasterCard as two great examples of that they continue to try to innovate and continue to try to evolve in what they do. And to me, that sets them apart and allows them to continue to thrive because it could be very easy. We all joke, that they could turn the lights off and the business will still run. It's become that much of a machine, but they continue to try to innovate and execute and try to pivot off of what they're doing to try to, maintain relevance. And so many companies, when the management gets, a little, I think I like the phrase you used a while back, fat and happy, it tends to start to slide, and they change. When the board of directors, like in Intel, they changed their focus away from what Intel was good at. They took their eye off the ball, in essence. Then you see what happens, because they're not taking their eye off the ball. NVIDIA and AMD were not taking their eye off the ball, and that pause allowed them to overtake. And same with TSMC. So I think when you're thinking about these companies we want to buy and hold for life, it's important to think about, where are they going and how they're going and what they're doing. And that's what I love about like a Google and a Microsoft too, is that they're not just sitting on their laurels. It'd be real easy to sit, hey, I got YouTube and search, I don't need anything else. I'm good for the next 20 years. Well,
right.
Competition and, the marketplace shows that that's not always the case. So
yeah, even American Express, we always think of that as like, oh, it's been American Express. They've been forever.
Old, boring, stodgy company. Far from it.
I think they made their butter in the traveler's checks.
Yeah.
And now it's a completely different business.
Completely different.
Yeah. And you go as far back as Wells Fargo with the horse and carriage and
right.
stuff.
Yeah.
And yeah. Banking's obviously different now too, and what they do. So yeah, evolve or die.
Yes. Yep. Evolve or die. Yeah. That was from Moneyball.
Was it?
Yeah. Billy Bean says that in one of the scenes.
Oh, no way.
Yeah. Adapt or die is what he says, but you can evolve and die. It's the same thing.
I guess that just shows how much it's just like naturally in my blood, right?
Right. Yeah. Yeah, exactly. Exactly.
Cool. Well, we hope that this was helpful. No promises it was entertaining, but if it was, that's awesome. Any questions you guys have, please reach out. We're on Twitter. We have newsletter at investingforbeginners.com. You can reach out and give us your questions, and we might read it on the show. So take action today, connect, learn, and grow with Value Spotlight. Peace.